AI is eating the venture capital space, but we don't think that's necessarily a bad thing.
AI has become very much the linchpin in this economy and in this market.
The percentage of articles and people mentioning AI bubble in the news has certainly climbed over the last couple of weeks.
And what I think may be the chart of 2025 so far, the fact that these two things are contributing about the same to overall GDP growth is very unusual. We are seeing very powerful growth in investment in equipment, but really nothing in the way of new hiring.
Certainly the biggest question probably in markets today,
which is AI in a bubble? So the title of our fourth quarter outlook is Circles. Circles doesn't just reference this idea of one of the things that you've probably heard a lot of talk about over the last couple of weeks, of this idea of circular financing going on within the AI space. But what we're really talking about here is how much the economy has started to look like the markets. Now, you've probably heard the phrase plenty of times that the economy is not the market, meaning there's times that the economy might be struggling, but markets are doing okay. But one of the things that's really fascinating through 2025 is we've actually seen the economy start to mirror what's going on in the market much more. And what we mean by that is that a lot of the market's concentration and really reliance on AI as a key driver of returns, something that we're going to talk about a lot today, but that concentration is now being reflected within the concentration of where growth is coming from in the economy. So what we're talking about here is this idea that the S&P 500 has become reliant on AI, and the U.S. economy has become reliant on AI. And in another fun little layer to these circles, what you also see is that the U.S. consumer, which drives the U.S. economy, has also become reliant on equity market returns, which brings us back to AI being reliant to be able to drive those returns. So to put this, and that was a very complicated explanation, here's how we kind of see all of this reacting to each other. Here you can see on the very far left-hand side, you have the start with AI capex, which is driving equity market returns. That's helping to drive U.S. consumers, which is also helping to drive U.S. economic growth. But U.S. consumers being so reliant on equity market returns means that they are thus reliant on this AI capex boom continuing. And one other interesting layer to this is that U.S. equity market returns actually make AI capex more powerful, or potentially have even more of it, as we're seeing a lot more of these deals of companies investing in each other and using stock in order to make the investments. So all of this is to say is that this kind of circular reference means that AI has become very much the linchpin in this economy and in this market. And that if any of these things were to get challenged in any way, such as a major slowdown in AI capex, which is not the call we're necessarily making, but if you were to see that happen, that a lot of this growth would start to slow and you sort of see it cascade more to the downside than versus what we've seen of this sort of circular reference to the upside. So that leads us to a summary of what we're expecting for the fourth quarter. We make this observation about AI capex being so very important, and it does feed into what we're expecting through the end of the year. So let's just talk about these 5 items just broadly, and we're going to dive into a few more details as we go through this discussion. The first one is just talking about the economic outlook, and what we're observing here is this decoupling, this idea that we have a softer labor market, but it's not necessarily showing up in GDP growth because you have a resilient consumer, this consumer being very top heavy, driven by the highest income earners in the US economy, but also because of AI related investment, which is not necessarily reliant or is sensitive to the labor market. And what this means and translates to is a muddle through kind of growth environment. And this has been what we've been expecting all year. After 2 really gangbusters years for growth, we were thinking that we'd get this muddle through. And now it's having this flavor of growth being just slightly at trend, maybe slightly below trend, a little bit higher unemployment, and inflation that's elevated around 3%, partially because some of the tariff impacts, but also some of those tariffs metastasizing through the economy. So what this leads to, and you've probably heard us use this term quite a bit, is this idea of stagflation light. This idea that you're seeing weaker growth or somewhat softer growth, a little bit weaker of an employment environment, and then sticky inflation all wrapping into stagflation light. What that means for fixed income, we think that yields are going to remain range bound. The idea being here is that yields are pressured to the downside because some of those growth fears or employment fears, but they get pressured to the upside because of a lot of fiscal spending. We think that you'll also likely continue to see that yield curve steepening, which we can talk about later. We do think that there are opportunities within things like longer duration municipal bonds as a diversifier in portfolios. And note here that this is the only part of the market that is actually seeing negative returns in 2025. So we think that there's opportunities for selectivity there. From an equity market perspective, we'll talk a lot about how we see a potential for this continued kind of melt up in markets through the end of the year. We think this is driven by dynamics such as positioning, liquidity, seasonality, which is typically strong in the fourth quarter, as well as earnings optimism. You've probably heard us also say that as long as 12-month forward earnings estimates are making new highs, you're likely going to see the equity market to make new highs. And the challenge we have that we'll talk a lot more about is this concentration within markets and asking the question of when does it end? Now, one thing we note here is that the bigger the rally we see into the end of the year, the more challenging we think the setup will be into 2026, which just means if we get to 7,000 or above by the end of the year, you'll be trading at very high valuations into 2026, about 23 times or over 23 times forward, going into 2026 earnings, which just means you'll be pricing in a lot of good news, no contemplation of bad news. By that point, positioning probably will get fully invested. Sentiment will likely be stretched at that point as well. And so it could set up for a bit more of a challenging start for the next year. From a real asset perspective, we're going to be talking about this in the context of debasement. A lot of concerns about debasement have been swelling around the markets over the past few months, and that has certainly shown itself in the price of gold, for example, where gold has reached over $4,000 an ounce. We've seen an incredible rally this year, big, huge rallies in Bitcoin as well. And talking about what does this mean for the narrative around debasement, concerns about fiscal dominance, concerns about sticky inflation. We're going to wrap up the outlook and some of our positioning and talking about alts. We're looking at ways to take advantage of the AI capex investment story through alternatives. And something that's been a theme for us for over the last 12 months is this idea of finding ways to put diversification in portfolios by looking at alternatives that are uncorrelated to markets, adding to return and not necessarily having us get increased exposure to things like public markets and equity or credit. So with all of that outlook as a summary and going through what we think about all these different parts of the market, the way we're going to answer the rationale for how we got to that outlook is by looking at these big topics. And we're going to be talking about these questions as we move through the outlook. We'll talk about whether AI is in a bubble, whether equity market concentration is a near-term risk. We'll talk about what is actually driving consumer spending. Spoiler alert, it has a lot to do with the equity market. We'll ask the question, is AI eating the economy and crowding out other spending? And the last one is policy shifting the backdrop for growth. What is the mixture of fiscal policy, monetary policy? Is it really going to be impacting growth? And last but not least, and probably most important, is so what do we do about it? So with all of those things to cover, I'm going to turn it over to Jay Peters in order to talk about the first question, which is AI in a bubble?
Great. Thanks, Cameron. And certainly the biggest question probably in markets today, hard to overstate the impacts that AI capex has had on equity markets over the last couple of years. There's certainly arguments to be made on either side of whether AI is in a bubble or not in a bubble, but I think there's clearly bubble-like conditions in certain areas. If you think about the circular nature of the AI capex, some of the vendor financing that Cameron talked about, some concerns about the pace of monetization and the adoption of AI. We think the bigger question is really not, is it a bubble, but where are we in the evolution of this capex cycle? Because it's possible that there's a lot of runway ahead of us, despite the massive amount of spending we've seen. Historically, bubbles are not that uncommon. They typically occur with secular growth stories, and we saw one 10 years ago with the shale oil boom. We've seen many throughout history. The dot-com bubble back in the late 90s. They typically occur with excessive optimism, prices that meaningfully deviate from underlying fundamentals. And then they tend to burst or fade when the expectations fail, when the reality fails to deliver on expectations. So I think framing it in that sense, we're going to dive into kind of how the fundamental story looks for a lot of these AI sort of spenders and beneficiaries. But we do think, if we aren't in a bubble yet, we're probably on our way there, but it doesn't mean we have to sort of be unexposed to this part of the market. I think some very smart people are pointing out that some of the risks out there are valid, but being early to call sort of the top not only is incredibly hard to time, but it's the same as being wrong in our view. So on this page, I actually just wanted to show a recent picture of the OpenAI Project Stargate data center down in Texas. This is a facility that is one of the largest in the world. It's one of potentially 10 data center facilities that OpenAI has contracted. It shows you what $50 billion in capex buys you. And not only is it massive in scale, it's about the size of Manhattan below Central Park, but just it's the sheer quantity of infrastructure components that go into these facilities is something. And what you can't really see in this image is that they actually built their own power generation facilities on site. And when this thing is up and running, it's expected to consume more electricity than all of San Francisco. So just tells you how big these projects are and where a lot of this capex is going. And on the next page, we wanted to talk a little bit about sort of the AI bubble narrative. And as you see on the left here, the percentage of articles and people mentioning AI in the news or AI bubble in the news has certainly climbed over the last couple of weeks. We have seen these sort of spikes in the AI bubble narrative over the past couple of years. What I did here in that yellow box is just said, okay, if you invested at sort of the peak of the AI bubble talk back in January 2024, how would you have done? And I know it's hard to see off to the right here, but the S&P is up about 40% since the last time we saw this sort of peak AI bubble concern. It tells you that even if we are in a bubble and people are talking about it, doesn't mean there isn't still potential upside in markets. And the Mag 7 segment is up almost 100% since January 2024. And Goldman has a basket of sort of the leading AI beneficiaries, which are up over 300%. So there's an incredible amount of investment that's gone on and a lot of money that's been made despite some of these bubble concerns that we've seen pop up. And on the next page, I wanted to outline what does this sort of AI infrastructure ecosystem look like? And what fuels it is really the demand for compute. And it's largely coming from AI, but it's also coming from enterprises moving to the cloud and the growth of the digital economy. So these are big secular growth stories that are fueling the revenue growth for the hyperscalers. And the hyperscalers are the biggest spenders in the AI ecosystem. As long as they're seeing 20, 25% year-over-year growth in their cloud businesses, they're probably going to continue to invest to build out the infrastructure to support that compute demand. These companies also have healthy and really strong core businesses that generate a lot of free cash flow, allows them to use that free cash flow for investment as opposed to using their own balance sheets. That's a little different than what we've seen in past investment bubbles. But I also think it's something to keep an eye on because growth rates in the capex, they've been remarkable over the past several quarters, growing 50 to 70% year over year. Those growth rates are likely to normalize in the coming quarters, closer to say 20 to 25%, still growing at a pretty remarkable rate. And I think that tells you that there's probably still a lot of spending to come, but that spending is going to be predicated on the macro environment remaining healthy because a lot of these hyperscalers or core businesses are still sensitive to the overall macro environment. The last thing I'd say is that the leading AI companies, the open AIs of the world, say that the path to getting broader AI adoption is going to come from more advanced AI models. And to get more advanced AI models, you need massive amounts of compute. And so it is kind of an interesting circular system that's in place, but it continues to drive equity markets. A lot of these resources for compute are capacity constrained. And the outsized investment continues to be well received by investors. Like any investment boom, this will fade and we'll have to sort of square the ultimate ROI and monetization for all this investment down the road. But for the meantime, it looks set to continue. And on the next page, we have a look at the state of AI adoption. There aren't a ton of ways to measure this, but one way you can do it is looking at the percentage of companies that are paying for AI models. It doesn't tell you that they're using AI to drive productivity or find cost savings, but it does tell you that a lot of companies are exploring ways to integrate AI into their businesses. As you can see on both of these charts, the adoption rate in terms of companies paying for AI models continues to increase, and it's encouraging to see. It's pretty broad-based. A lot of it's coming from technology and the financial industry, which are two sort of technology-forward industries. And I thought it was interesting yesterday, Jamie Dimon said, for the $2 billion of it that they're spending on AI R&D, they've already seen $2 billion worth of cost savings. So there haven't been a ton of tangible evidence yet that AI is going to drive productivity and cost savings. But I think we are starting to see some signs that the adoption is starting to make its way into the large corporations in the country. On the next page, I wanted to just quickly touch on the next 5 years and what that looks like for compute demand and capex. And we're expected to see compute demand basically grow 22% annually over the next 5 years. And the vast majority of that's coming from AI compute, expected to triple over the next 5 years. It's why we're seeing so much capex. If this compute demand continues to grow at such a healthy rate, it leaves the hyperscalers sort of capacity constrained, and it's why they continue to invest to build out more capacity. And McKinsey pegs it as about a $6 to $7 trillion worth of global data center investment that we're likely to see over the next 5 years. And over the last 5 years, we've seen about 1.3 trillion. So in that context, it tells us that there's potentially a lot more capex to come. I think even in a more modest scenario, we're likely to see more than twice the amount of capex we've already seen over the next 5 years. A lot of that benefits the semiconductor ecosystem, from the networking chips to the equipment to the storage chips. The question is how much of this has been priced in so far. I think a good chunk of it has been, but I think that's why on days where you see these announcements about the next sort of AI company investing, the next 10 or $100 billion, it tends to be well received by the market. This is something we talked about at the beginning of the year in our outlook call. We said, really, the biggest bottleneck in AI is in this power segment. For all the data center capacity that's coming online, there just isn't enough electricity to power these facilities. We're expected to see data center power consumption double over the next 5 years and reach about 12% of the total electricity consumed in this country. And, that's up from 2% just a few years ago. So even though it doesn't feel like it's a massive number, the amount of stress that it's putting on an already strained power grid is remarkable. And you're seeing that show up in electricity prices for consumers. They have been ticking higher. There just isn't enough power available to fund these data centers. And even though there's projected of 50 to 75 gigawatts of power coming online in the next couple of years, that's not going to be enough to support the demand. That's the growth. Data center capacity continues to outpace the supply of power. So we still think this is a really interesting place to be invested. It's where kind of the supply-demand imbalance remains challenged. And I think a lot of AI infrastructure or companies are going to have to start to invest either in behind-the-meter facilities, which means bringing your power on site, building your own power generation facilities, or partner with some of these large independent utilities to secure some long-term power. So just to close out the story on AI, we think we're still in the middle innings of the capex cycle. Certainly agree that there are some longer-term concerns about the overinvestment and the pace of monetization, but as long as the cloud revenue growth continues to remain robust, something to keep an eye on in the coming weeks when a lot of these hyperscalers report earnings, that can still justify healthy capex growth and investment in fueling a lot of earnings growth for the sort of the AI beneficiaries in the market. I think on the positive side, the hyperscalers are self-funding. Haven't used a ton of their balance sheets to build out this infrastructure. The capex to operating cash flow has ticked to a pretty high level. So I think we're getting closer to sort of levels where these companies are going to have to start to moderate the growth in the amount they spend. But really, the long-term assumptions tell us there's probably a lot more capex to come in the AI infrastructure ecosystem. And as this cycle ages, we just think it's paramount to be diversified, not only within the AI ecosystem, but maintain exposure outside of the AI ecosystem to areas that can offer attractive fundamentals that aren't going to be so tied to this generational theme that has had such a large impact on markets. And then just things to think about is the expectations are certainly high. There's a lot of competition that can breed inefficient capital allocation. So certainly expect probably lower than expected ROIs in the future. Closely watching the pace of monetization and adoption and comments from corporate America and large company CEOs and talking about how they're integrating AI into their business will be key to supporting all this spending going forward. And we'll touch on the valuations in a minute, but they've risen, but they're not to an extended point where you could say they've really meaningfully deviated from underlying fundamentals. And then lastly, AI as a secular theme is still not immune to the overall macro environment. So as long as that can stay healthy, we think there can be sustained momentum in the capex story. Now, the other big question in the equity markets is about the concentration of the indices and concentration of return. It's been a historic couple of years. If you look at the S&P 500, it's as concentrated as it's ever been, with 10 companies making up 40% of the index. A lot of this has come from underlying earnings growth, however. It's not necessarily, like we just talked about, a meaningful deviation from fundamentals. It's the largest companies that produce the bulk of the earnings growth in the S&P 500. And looking ahead, that continues to be the case. If you look at the market cap weighted S&P versus the median S&P stock, those companies at the top of the market continue to offer premium EPS growth going forward. And that's a function of having economies of scale, the ability to move your supply chain around to navigate some of these input cost pressures. The largest companies tend to have labor costs that are a lower percentage of their total revenues. So a lot of things kind of working against the median stock are actually things that have worked for the larger segment. And that's why we started to see this bifurcation over the last couple of years and why it's potentially going to continue here, even though we would love to see a broadening out of performance. If you go back to November 2022, AI-related companies have accounted for 75% of the S&P's total return, 80% of the index's earnings growth, and 90% of the index's capex. Just incredible levels. That's why we've seen so much concentration. And as long as that capex is going to continue, it's hard to say that concentration is going to turn anytime soon. And just looking at this year, just 8 companies, the Mag 7 and Broadcom, have accounted for half the S&P's total return. And those same 8 companies have accounted for more than half of the S&P's total return over the last 3 years. It's been a tough market for active managers. There's only 23% of companies are outperforming the S&P over the last 3-year period. We still think that there's a ton of opportunity in active management and using fundamentals, especially as the cycle ages. And we're going to see earnings growth become a more important driver of performance. But certainly been just a remarkable couple of years in equity centered around the AI theme. And then on the next page, you just wanted to have a look back at the last 6 or 7 years of the Mag 7 versus the average stock. And this is why we've ended up where we are today. This is remarkable earnings growth for the Mag 7. It's just vastly outpaced that of the average stock. So in many ways, it's been fundamentally driven concentration in the market. And it's hard to say that this is going to turn anytime soon. On the next page, I wanted to quickly touch on underneath the surface of the market, looking at different segments and seeing where the earnings growth and performance has come from. And the Mag 7, despite being down almost 25% peak through the April lows, is now back in front, up over 20% for the year. And over 80% of that return has come from underlying earnings growth. Similar story for the large growth segment. A lot of their return has come from underlying earnings growth. And what jumps out to me on this page is that the Russell 2000 still posting a respectable 13% total return for the year, but none of that has come from underlying earnings growth. It's been sort of when is the Russell 2000, when is the small cap segment going to show the earnings growth? I think a lot of the performance and multiple expansion is based on the expectation of future earnings growth. And as you can see on the right, for 2026, most market segments around the world are sort of expected to see double-digit earnings growth. Small caps jump out again as a segment that is expected to see 40% year-over-year EPS growth. That's very similar to what we expected for this year. And if you just turn to the next page, small caps, despite coming into the year with lofty expectations, have failed to really produce any earnings growth. And we've seen these downgrades throughout the year to the small cap year-over-year earnings growth estimates for 2025. As Cameron says, just because it's consensus doesn't mean it's going to happen. And I think we would certainly love to see better participation from the smaller cap segment. We think there's a lot of opportunity for stock selection here, but the environment has certainly been challenging relative to the large cap space when you think about where the earnings growth is coming from and what the headwinds that the average small cap company are facing. On the next page here, we have a quick look at the S&P 500 and projected earnings growth. And really, this is just illustrating that the trajectory of earnings growth drives price. And that's what you see in this blue line is that as long as the earnings expectations are rising, typically the S&P 500 tends to follow. And when you see the earnings environment, when the earnings expectations fall, it's usually a headwind to equity prices. So these earnings expectations for 2026 have continued to grind higher. That's one reason why the market has continued to perform well. And then just lastly, touching on valuation, I think it's fascinating that the Mag 7, despite all of its outperformance over the last couple of years, is actually not that expensive compared to the rest of the S&P 500. It's always traded at a premium, but that premium is down from, say, a 50% average. It trades around a 35% premium today. So once again, tells you that a lot of the performance of the Mag 7 has been hard-earned from earnings growth. And when we look at the equal weight S&P 500, there is a substantial discount here relative to the broader S&P. I think this is part of the story with the small cap segment as well, is that there is an opportunity from a valuation standpoint, but we're not seeing the underlying earnings growth to provide the other piece of the puzzle here. And so we'll see what 2026 brings, but ultimately we think that this is probably a market that favors the large growers and sort of the piece of the market that has those AI tailwinds relative to sort of the other 493 or the average stock. And as you can see, the S&P is still trading at the high end of its historical range. 22.5 times forward is about as expensive as we get. We did get up to 25 times back in the tech bubble, but this is certainly something to be mindful of. A lot of this valuation, the market's been able to sustain this valuation because of its healthy earnings growth and exposure to just these AI infrastructure names that have produced so much fundamental growth. And lastly, on the positioning in the equity markets, this has been a certain tailwind over the last couple of months. We crossed our sort of average threshold, and now we're kind of just back to maybe a little bit above average in terms of consolidated investor positioning. Certainly something to be mindful of. As this ticks higher, it likely means that you should expect maybe equity markets to be fully priced, fully valued, or those tailwinds from the rebuilding of positioning tend to fade. It just means that likely means for a little bit more of a challenging environment for the overall equity market. And one more slide is just our outlook for our scenario analysis for the S&P 500. And I think just looking at the bottom half of this page, you can see that on 2026, EPS expectations are for around $300 per share at a sort of 23 multiple. That's around 6,900 on the S&P 500. That's a little bit above where we are today. So it tells you the market is still pretty fully valued. Certainly could see EPS come in a little bit above or below this number, and we could see the PE on the index range from 20 to 21 on the low end to 25 on the high end. So expect a wide range of outcomes, but it does feel like the market is certainly gravitating towards the higher end of this valuation range. And I will turn it over to Brian.
Thanks very much, Jay. So we're going to move on to the consumer, but that doesn't mean we're going to leave the equity markets. As Cameron said at the outset, the consumer story in the U.S. in 2025 is inextricably linked to the equity market story and by extension, the AI story. If you look at household allocations of their overall financial assets, households are holding the highest allocation to equities that they have in sort of recorded history and recent memory. And that may be because people are simply not rebalancing because they don't see any other alternative, regardless of the fact that stock markets have gone higher, the valuations are stretched. There isn't an attractive alternative, whether it's cash, fixed income, other options people have. Or it could be because investors are becoming more risk on and are allocating more to equities and chasing the market upwards. But the reason this is important, if we go to the next slide, is there's two things that really dictate how consumers decide to spend or save. The blue line on this graph is showing you net worth as a percentage of disposable personal income. And the black line is showing you in an inverted way, the US personal savings rate. And these two things tend to move in tandem. For most households, the largest asset they own will be their homes. But the thing that dictates the volatility in the value of those assets tends to be the equity market. And as the equity market moves higher and households feel wealthier, one of the things they'll tend to do is save less of what they earn. So you've seen these two things move up together. Household net worth has moved up and the savings rate has moved down. And that is one of the things that's really driving the consumer. There's also a consideration of what's going on with the labor market. We'll get to that. But for a lot of the consumers that really matter to the economy right now, the rising stock market has been what's driving the confidence to continue to grow that spending and to continue to save less of what they're taking home. So you can see on the next slide here, what's really important about this story, and I think it ties it together, is it's really the higher end consumers. Wealthier consumers, higher earners who are going to tend to be disproportionate owners of equity market in their personal assets. Those are increasingly driving the bulk of consumption. The top 10% of income earners now drive about half of overall personal spending. Not to say that the bottom 90% don't matter, because that's the other half, but we know that the sensitivity of that top 10% to things like what's going on in the labor market may not be as powerful, whereas the sensitivity to what's going on in the stock market may be the overriding concern. We've seen this in the past. This last slide here in this section will show that quite well. In the 1999, 2000, 2001 period, we had this very, very powerful equity market rally based on a lot of optimism about technology, specifically the internet. And then at the same time, we had this very, very powerful consumer spending growth story. And it was only just as the market was peaking that the year-over-year rate of retail sales growth also started to come down. There's a very strong correlation here between what the equity market was doing, it is a leading indicator for the economy, and what consumers ended up doing, because so much of what was driving consumers back then was the sense that they had become wealthier. And as that wealth tended to recede, they also changed their spending habits. So let's now talk about the broader economy. Let's keep the topic on AI, but apply it to the larger economy and ask the question, is AI eating the economy? If you be forgiven for looking at this graph and saying that AI is eating the venture capital space, but we don't think that's necessarily a bad thing. In fact, as Cameron will get to at the end when we talk about our alternative themes, where we have conviction, it is in venture capital where we think there's great opportunities. A lot of those opportunities are tied to AI, but you can see the diminishment in a lot of the other types of what had been very kind of hot places for venture capital, whether it was crypto or software. Those have really receded and given way to this very powerful AI story. Let's dig into the economic data and what I think may be the chart of 2025 so far. In the first 2 quarters of the year, the quarters that we have data for, contribution to overall GDP growth, which has been about 2% if you look at the core growth, it's been about equal between consumers, who are usually the overriding contributors to economic growth, and spending on computers and software, which has really started to come up. There's not a lot of volatility in this graph, but you can see that this contributing 1 percentage point to GDP growth for this relatively small, normally, share of the overall U.S. economy is punching way above the usual weight class. And with the fact that these two things are contributing about the same to overall GDP growth is very unusual. It's usually only during recessions, when consumers are actively pulling back on spending, that you have equipment and software spending kind of contributing more than overall consumption growth. In this case, they're contributing about the same amount, but as we've already covered, a lot of that consumption may be implicitly backed by optimism around AI that's powering the equity market, which again is powering consumers. So there's a lot of AI on this graph, even in the places where it doesn't seem like it. What has been happening in the last couple of years, really from 2022 through the middle of last year, was you had this really powerful explosion in factory building, construction for manufacturing structures. And that was on the back of the CHIPS Act. Now, what was going to have to happen, as Jay alluded to, is we're going to need a lot more construction, not only at AI data centers, but other things to power those data centers. We're including power and electricity on this graph as well to show that these were basically growing in line with that factory growth up until the CHIPS Act. And then the factory growth sort of exploded. Now, what's happening now is it's no longer contributing to growth. The building out of factories is receding somewhat as other things are coming online, like data centers. We're switching what kind of things we're spending money on in terms of the construction. The absolute level of factory construction is still high, but it's not contributing to growth anymore. You can see really well in this next chart exactly what the timing was of this explosion. It was right after the passage of the CHIPS Act. Factory construction was already on the rise, but it really took off after the CHIPS Act. We obviously haven't had a similar legislative effort to try to get more data centers built or more power built. That may happen at some point. But what's important to note here is that the thing that's going in as an input to these data centers, the computers that are powering the data centers, those are currently not subject to tariffs, where a lot of the things that are going to be inputs into a lot of other types of manufacturing are. So if we kind of go where the money is and go where sort of the cheapest input costs are, companies are not having to pay tariffs to import the parts that they need to power the data centers. And that's not true of other factories, like, for example, auto factories. Let's talk about where we're seeing the construction in non-residential investment. So this is the amount of construction that's being built by sort of the purpose of the structure. You might be really surprised, I know I was, to see offices still so high. Came down after COVID for very understandable reasons, but still kind of the dominant structure in terms of new construction in the United States. But it's really the data centers that are the standout of this graph. The only place where you're seeing growth in non-residential construction is in the construction of data centers. We should also be seeing eventually those electricity and power generations come online as well, usually in areas where the data centers are. And let's talk about the residential construction sector as well. This tends to be a contributor to the economy early in a cycle and then tends to recede as you see things like rising interest rates and as people become less likely to move. This cycle has been very, very different, though. We had this huge boom in construction coming out of the pandemic, and that gave way to now historically low level of home builder confidence and a plummeting level of building permits for single family and multifamily homes as builders simply look at the environment where we're seeing home prices falling in a lot of areas of the country, where financing is still very, very expensive in many places. Mortgage rates still well above where they were, obviously pre-2020, and are just simply choosing not to build. So a lot of the economic activity that would be happening is not happening, and it's being sort of replaced or taken up by more investment in this one very kind of narrow area of the economy related to data centers and AI power generation. So this is a very unusual circumstance as we get to the labor market now. We are seeing very powerful growth in investment in equipment, which we've covered, I think, in detail here thus far, but really nothing in the way of new hiring. Whether you're looking at the public sector data, private sector data, a lot of that's come online since the government shut down. A lot of private sector data sources all of a sudden springing up and telling us the same story that we knew already, which is private payrolls are not growing in any meaningful sense. And this is a very unusual circumstance. You can take this graph all the way back to the early 2000s. It's hard to find a time when you had a lot of kind of really powerful investment happening, but you had hiring getting pulled back. So I think what we can say is that AI is an unusual type of investment in that it doesn't necessarily lead to job creation, but we are also seeing evidence that the inflation related to electricity costs, the consumer price inflation category just for electricity, may be higher and persistently high because there are new sources of demand for that power springing up all over the country. And that could be pushing up electricity costs, or at least keeping the rate of increase in those electrical bills that we're all getting higher than it would be otherwise. We're nowhere near where we were kind of post-pandemic when there was a huge surge of demand and inflation across many, many different sectors in the economy. But the fact that we haven't seen this one normalize to any significant extent tells us there could be something else going on. It could be related to data center power demand. Talk about the labor market as it relates to the consumer. This is where we think the most important potential crack is forming in the economy, is that consumers' assessments of the labor market have just been getting worse and worse. This black line here is telling you the difference between how many consumers are reporting jobs as plentiful versus those reporting jobs as hard to get. And that's been getting worse pretty steadily now for a few years, but especially in the last couple of months, that has historically been associated with higher unemployment. Consumers are quite good at taking the temperature of the labor market. And one of the things they're telling us right now is the labor market is getting worse, and they expect it to be worse a year from now. They expect higher employment a year from now. That could be dramatically influencing spending decisions happening at the household level, particularly for that bottom 90% that don't have as much in the stock market and aren't feeling that wealth effect and are much more concerned about a negative income effect if they were to lose their job or had to take a pay cut at some point in the next year. But we're also seeing fewer workers quitting their jobs. There's a quits rate number that's tracked by the Bureau of Labor Statistics that's showing that month after month, with a few bounces and wobbles here and there, the number of workers that are quitting their jobs is continuing to come down as workers feel less secure. And this, we think, is a forward indicator, has been historically a leading indicator for weaker income growth. And again, weaker income growth is going to mean less of a base from which consumers can continue to spend. Here's where the but is coming in. We have seen in the third quarter, and so far in the early days in the fourth quarter, better than expected economic data. The expectation, especially coming out of Liberation Day and the tough sledding in some of the markets and the economic data over the summer, early summer, as we've gone later in the summer, things have turned up. We have seen better numbers for manufacturing. We've seen better numbers for early indicators of capital goods orders, more businesses ordering things with the tariff uncertainty mostly in the past. And this optimism has led, as you can see on the next slide, economists to upgrade their forecast, not just for 2025, where we learned that the second quarter was a good deal stronger than we thought from a GDP perspective, but also for 2026. So we've come almost full trip in the 2026 forecast, this blue line here, from the beginning of the year where people saw it as about a 2% kind of trend growth year. We went all the way down to 1.4%, considerably below trend, and we've now come back up to around 1.8. Also for 2025, we haven't quite round tripped. We're not going to get back to that 3% growth year because the first quarter was negative, but we are inching back up as the economic optimism, and that's certainly tied up in what the stock market's doing as well, continues to improve at the margins. So let's talk about public policy. There's a lot to discuss here. The big story right now, obviously, in the moment is the government shutdown. We're not getting any economic data. Importantly, neither is the Fed. This is contributing to a lot of uncertainty. We're not going to get inflation data like we were supposed to. In all likelihood, next week, we didn't get the jobs report last week. We don't know what the labor market situation was in September. We have a pretty good idea from some of the private sector data, but not officially from the BLS. And the expectation in the markets, in this case, the betting markets, is that this shutdown is going to go on for quite some time. This is 21 days. The last time I checked, just before this call started, we were at 24 days. So things are moving in the wrong direction from the perspective of anybody who would like the government to reopen. This could start to cause some economic pain if we start seeing government workers missing 1 or 2 paychecks, even though in all likelihood, they're going to be reimbursed once the furloughs are over. Some of that economic activity that would have happened otherwise is going to be lost. We'll never quite get back to where we should have been if the shutdown goes on for, say, 35 days, like it did back in 2018 and 2019. One of the other sources of uncertainty is on the tariffs, which are in legal jeopardy. The Supreme Court is hearing a case arguing that the tariffs are not legal and that companies should be reimbursed for what they've paid so far to the government to import things from the beginning of the kind of onset of the tariff regime. This doesn't apply to every single tariff. Some of the tariffs are country specific or product specific after significant periods of study. Those are not considered emergency tariffs, but the bulk of the tariffs were enacted under an emergency statute. If that statute ends up being struck down or the tariffs end up being found to not be valid under that statute, a lot of this money could be reimbursed. And that's right now, $1 to $2 billion a day that's being taken out of the economy as importers pay the tariffs that could be put back into the economy. It could almost act like a stimulus. But obviously, it's creating a lot of uncertainty on the part of the companies in the meantime, and it was also creating uncertainty on the part of consumers who continue to expect higher inflation at some point. We just haven't seen that big spike yet based on the tariffs that have gone into effect so far. This is also complicating matters for the inflation outlook. The broadening of inflation is something that will not be welcomed by pretty much anybody, especially people at the Federal Reserve who would like to see interest rates come down. We are seeing a higher and higher percentage of goods and services reach and breach that 3% inflation threshold. So that means you're 1% above the Fed's target and moving in the wrong direction. And as inflation gets broader, it will become harder to tame and harder to make the excuse that it's going to be transitory or only affect a handful of goods that are being impacted by the tariffs. We are not yet at the maximum broadening of inflation that we saw at the peak in 2022, but we are as high as we have been outside of that period, certainly for the last several years. Ultimately, this is going to make things very difficult for the Federal Reserve, which met last month and decided to cut interest rates. There was some disagreement as to how much to cut, but they did cut interest rates 25 basis points. They're going to meet again on October 29th. even if the government is not open by then, and they have to really be flying blind in terms of what to do about monetary policy. But you can see even before the shutdown, there was a huge amount of dispersion, uncommonly large amount of dispersion, both for this year and for next year, and really all years, all time horizons on the committee as to where interest rates should be. There's just not a central tendency on the committee right now for whether rates should be cut only once or twice more or a lot more times through the end of next year. And that's going to continue to create market uncertainty as well. There's people on the FOMC who are arguing that rates need to come down because policy is much too tight. There are people in the FOMC who are making a slightly different argument that the labor market is getting weaker, which we agree with. And that is one reason why we need to be a bit more cautious about keeping rates where they are. And we should be preferring to lower them. And there are people who are saying, but gosh, inflation is still 3%. How can we be cutting interest rates and loosening policy at a time when we haven't achieved our 2% inflation goal? The fact that we're not getting any economic data is not helping the Fed resolve this issue internally and is not helping the markets get a clear sense of where rates are likely to go next. Interest rate volatility has been uncommonly low since the government shutdown because there just isn't much information coming out that's directing people who own bonds or who want to make bets on interest rates to have any kind of idea of where things might be heading. So what we think is going to happen with the Fed is that they're likely to cut rates at least once more this year. There's a 90% chance priced in for an October rate cut. Something dramatic would have to happen in order for that not to occur. But what we always say is you really do need to see much higher unemployment to get a lot more rate cuts. The Fed right now seems willing to look past inflation as a concern. We'll get to some of the market implications of that on the next slide. But so far, there isn't the urgency to cut rates by 50 or 75 basis points based on a rise in unemployment. If we get a couple of jobs reports that show unemployment going to 4.5% or higher, we could see bigger rate cuts. But until then, it looks like it's going to be steady as she goes, a rate cut every meeting or two, which is about what the markets have priced in. Let's talk about the implications of a Fed that does not seem as geared into the inflation story as a concern and seems much more focused on cutting interest rates to get rates down in the name of helping the mortgage market and helping the labor market. This is showing you the AAA rated municipal yield curve today and 1 year ago, undergone what we call the zoo steepening. So there's been a bull market in the front of the curve as short-term rates have come down. It's been a bear market in the back of the curve as rates have come up. Kevin McIntyre did ping me to remind me, Kevin McIntyre is our municipal specialist, portfolio manager, strategist, to say that after September's rally, the long end of the muni curve has actually inched its way above the Mendoza line and is now positive in terms of total return for the year. But you can see in the last year, the yields on the long end of the curve, and not just the long end, but everything basically outside of 9 years all the way to 30 years, are significantly higher than they were. And that has happened in part, and we've seen the same thing with the Treasury market. It's happened in part because the market has less faith that the Fed is targeting inflation in a serious way at 2%. So where the Fed controls the yield curve is at the shorter end. They can make those interest rates go down, but they can't make the longer term interest rates go down necessarily. If anything, it looks like they may be tolerating a hotter economy over the long run, and that is going to make investors demand higher interest rates for taking longer duration. Go one more forward just to show you the opportunity in munis where we think there is still a very good chance to pick up yield, especially for taxable investors on a tax equivalent basis. The muni index is giving you above 6% compared to the Treasury and the corporate credit index, where we've seen interest rates come down by more this year. The muni rates spiked during Liberation Day when there were liquidity concerns, and they've come back down, but they're still about where they were to start the year, whereas the other parts of the bond market, you've seen rates come down. So the attractiveness of munis is enhanced from the start of the year. It's one of the reasons it's one of our highest conviction areas for putting new money to work. Let's talk about one other thing related to this, dollar debasement. The big story in the first half of the year was the US dollar was getting weaker, less so in the second half of the year, but the types of assets that people hold as a substitute for cash, when there's concerns about the dollar getting weaker, those have tended to do very well. So we can go here from gold, which is obviously a very high profile way. It's had an excellent year. People look at gold as a substitute for cash when they're concerned that the interest rates available on cash are going to be lower than the rate of inflation. So just by holding money in a checking or savings account, you're going to actually erode the purchasing power of your money, and you might want to hold gold instead. Bitcoin has occasionally been correlated with this story as well, although you can see there's a lot more volatility to what's driven Bitcoin, or that greenish line, than has driven gold. And then if you want these kind of lower octane substitutes, real assets, diversified real assets, including commodities, including public infrastructure, public real estate investments, those have had a good year as well as kind of substitutes for cash, as has the tips market. And here we kind of put them on a spectrum for you from the lowest risk, the less likely to lose principal, to the most likely to highest volatility and arguably the most kind of overvalued relative to its intrinsic value. These are the options for investors who are concerned about ongoing, not just dollar debasement, but an overall strategy of running the economy hot. Even if the dollar isn't depreciating, your money might be losing its value at the very short end if the Fed's cutting interest rates and inflation is moving up.
Yeah, wonderful. Well, thank you, Brian, and thank you, Jay, earlier. So just as a quick reminder of kind of how all of these things flow in, we went through these questions about, is AI in a bubble? Are we seeing equity concentration risk? What does that mean for equity market returns? As you can see here, what we're talking about is our expectations for equity markets. It's that there still is this potential for a drift and a chase higher. We're identifying things like positioning, which Jay talked about, liquidity, seasonality, that earnings optimism, earnings being so very driven by AI that is what's pulling this market higher. And that what we're identifying as well is that to say the more you rally into the fourth quarter, mostly if that rally really extends beyond what we're seeing as far as an improvement in fundamentals, the more likely you have challenges going into 2026. But as long as you're still seeing those earnings revisions higher, that can boost the market. And of course, that brings us back to the AI story, back to the economic outlook about how much AI is really propping up the overall U.S. economy, not just the U.S. markets. And the end result is that you're getting these decouplings and bifurcations where capex is really strong, yet hiring intentions are weak. So effectively, what this economy is being driven by is a pretty narrow cohort of capex related spending. And I think one of the big questions is, as Brian was talking about, as we go into next year's policy outlook, is the policy enough to cause a broadening out, not just of the economy, but of the markets as well? Really remains to be seen. It's been sort of the hope springs eternal trade. And so what we're identifying here is that a lot of the momentum that has driven this economy and markets is likely to continue in the near term. Doesn't mean that there aren't risks. Doesn't mean that things like we're starting to see signs of frothiness in some sentiment. Positioning, we'll watch really closely. Valuations, of course, as Jay mentioned, are extraordinarily high. But in that backdrop, that's where the things like real assets and alts start to play a much bigger role. So with all of that being said, I'm going to turn it back to Brian to talk a little bit about how we're framing positioning into the fourth quarter and into the beginning of 2026, and this kind of construct of how we are paying homage to all the different sorts of our personalities as we're thinking about building a portfolio given this backdrop. So Brian, take it away.
Sure. So these are some investment ideas, hopefully general enough that they can apply to most investors, but doesn't mean you need to be going and doing every single one of the things on this list. And you see, we have them organized by pessimism, optimism, and nihilism. We don't think you should be choosing one of these paths and following it. We think you need to be doing some of all three of these in portfolios. Being optimistic, all the positive things that Jay talked about as it relates to the AI story, as it relates to the mega cap tech story, still being a not just a reasonable, but we think a necessary thing to continue to be invested in. But you have to be sensitive when you're looking at, especially the U.S. large cap growth space with the run that it's had, valuation and concentration. That third bullet, making sure that you have enough allocated to international markets, to mid cap markets, both of which have had pretty good runs at times in 2025, but are still under allocated to in most portfolios, given where the bulk of the returns have come from. And we think that alternative strategies should also be leveraged to the AI story. So as the extent you're picking alternative managers, alternative strategies, think about private infrastructure, all the things we talked about that need to be built out as part of the AI data center project, but also the power generation. We think that's a very powerful story where investors can take advantage of it, and also in venture capital, as we mentioned earlier as well. Pessimism, we're assuming if you're rebalancing, you're selling stocks and you're buying bonds. That act in and of itself might display some amount of pessimism, but we want to make sure we have enough credit quality in those bonds that we're not just moving into things that are going to end up very correlated with the equity market. You mentioned municipal bonds, especially in that 10 to 25 year range, have not had as good a run over the last year or so as the rest of the market and look attractive to us. And then for some investors who are extra concerned about the equity market, with volatility low, you can consider doing outright hedging and definitely want to speak to your advisor about that if you're inclined to do so. And then there's the nihilism where regardless of whether the AI story works out or not, or the economy continues to do fine or doesn't, these things can have a place in a portfolio, diversifying into uncorrelated alternative strategies that don't have any kind of a market bent to them. Making sure that with cash rates going down, you're invested in a strategy for those liquid short duration assets that is going to generate a high enough return for you, and you're not going to be settling for lower and lower rates because the Fed is cutting without taking undue risk. And then an allocation to gold or other sorts of liquid real assets as a hedge against dollar debasement or a hedge against a Fed that is no longer attentive to inflation risks. These things can be mixed together depending on your preferred cocktail of your financial outlook, your degree of optimism, pessimism, or nihilism. But we think all of these have some place in the discussions as investors get into the end of the year and certainly as we approach 2026.
Just one last thing to highlight and one reminder to everybody is that these charts will all be available. Know that there's a lot of words on these slides. So this is going to go into the details of what we're viewing within venture, correlated, and infrastructure. But alternatives is such a dispersed group of different kinds of asset classes. The way that we approach alternatives is always thesis driven. This idea of we're making an assessment of the macro landscape. We're looking for mega trends. We're looking for disruptions. And being able to take advantage of that macro landscape and play it out within the alternative side of things. And so one of the areas that we have seen a lot of opportunity and a lot of focus on this year is within venture. Something that we continue to see a lot of incredible growth coming, not just from AI, but also just all of the developments that are made possible because of the applications of AI. We've also, as I mentioned at the beginning of the call, been talking a lot about uncorrelated strategies over the course of the last over a year from now. This idea of looking for things in the market, this falls in that nihilist camp, looking for things in the market that don't care what the S&P 500 is doing, don't care what the Fed is doing, that can generate attractive returns that also have lower correlations to markets. This is such a powerful portfolio building block and building in that diversification out of things that don't necessarily care about where interest rates are going or, as I said, the equity market. The last one is infrastructure. And infrastructure is something that we did an assessment of portfolios over the course of the last year. And what we saw was that a lot of our investors were underallocated to infrastructure. It's because it wasn't nearly as exciting as what you could get for, say, out of the NASDAQ, which was compounding returns at 20, 30% a year. But as we're starting this next phase of this cycle with very high valuations, we think it makes sense to build things into portfolios that can generate that attractive returns, but still have lower correlation to overall markets. Infrastructure, kind of similar to ventures, that there's a lot of mega trends that are supporting it as well, whether it's the funding of infrastructure that's happening, the ability to be able to have that sort of inflation adjustment, which is built into a lot of these infrastructure deals. But then lastly, we know we have a huge build out of AI power infrastructure, which Jay talked about at length. So putting all these three things together, these are some of our core priorities as we think about alternatives through the end of the year and into the beginning of 2026. And know that we're always looking for those opportunities, those mega trends, as well as those disruptions in order to help guide us where we want to be focusing our attention within this broad asset class of alternatives. So with that, I know we have one question that came through about the breakdown of leading indicators.
The answer is, and this is going to get me in trouble as a recovering economist, is it sort of depends on which one you look at. The best leading indicators historically have been the financial markets, the S&P 500, the credit markets, the slope of the yield curve. These have all been things that have been reliable leading indicators for recession risk when they get especially concerning, but also just as a general slowdown in the economy. The S&P 500 obviously has continued to perform well. Credit spreads show no sign of financial stress in the corporate sector. And those components of the leading indicator index have continued to be quite good. On the flip side, the sentiment indicators, basically opinion polls, where we ask businesses, we ask consumers, how are things going? Those have not been as good. But that's been the case for a very long time now, going all the way back to the beginning of 2022. It's been a long time since we've seen a peak in a lot of these indexes, and they've come down materially and continue to come down. And so the leading indicator index is still going down, and it has been now for close to 3 years. And we just haven't seen the response in the economy anything close to what could be called a slowdown or a recession that would make you think that the leading indicator index is an overall reliable indicator moving forward. The financial markets, again, continue to kind of lead the way in terms of the outlook for the economy.
Thank you all for joining. Have a wonderful rest of 2025, and we'll be doing this again at the beginning of 2026. Hard to believe it's almost here. Thank you all, and have a great rest of your year.